Hello. So now we're going to talk about valuation of stocks. Starts on page 154 of your textbook. Stock is basically a share in the equity of the firm, a share of ownership in the firm. And when you buy a stock, the expected payout is the dividends, D, that it may generate throughout the years. Stocks are expected to pay out dividends, but are not mandated by law to do so. Nonetheless, dividends are the benchmark to price valuation. The question is, how much should we pay for a stock that is expected to generate dividends, in this case envisioned to be annual dividends? It could be quarterly, could be per semester, but for the sake of simplicity we are assuming that they are annual, and they're going to generate dividends for as long as the stock, the company, exists. And as we don't know when the company will cease to exist, we assume it to be forever, infinity. So conceptually, this looks like a perpetuity, as we saw in the earlier chapters, except that the annuity here is the dividend. We learned earlier on that whatever is that annuity, which now is the dividend, divided by the interest rate, gives you the present value of that stream of cash flows. And 2 days worth of these expected payouts is the fair price of the stock today. Or in other words, how much we should pay for the stock. So let's say that by assumption we assume this dividend to be $100 per year, and that our expected annual return per year, if we are to invest in this stock, should be 6%. So how much is it worth, this stock today? About $1,666.67. This will be the fair price to pay for a stock that is expected to pay out $100 per year forever, given that we require an annual return of 6% on this investment. Now, if you end up paying less than this amount, then you're making more than 6% per year. If you end up paying more than this amount, then you make less than 6% per year. You can see that inverse relationship here in the formula, which means that present value of this stream of cash flows moves inversely to the interest rate. Higher the interest rate, lower the current price. Lower the interest rate, higher the current price. Now, this stock we are talking about is a specific kind of stock. This is what we would refer to as preferred stocks. These are like premium stocks. Why? Because by definition, if there are dividends to be paid, these are the first ones to be paid out. And then we move to what we call common stock. And these are a second tier class of stocks. And these are the ones commonly traded, like New York Stock Exchange. When you buy stocks there, you're buying common stocks. Preferred stocks are typically sold to other types of arrangements, for example, through investment banks, and typically require a much higher investment. For example, when Warren Buffett bought stocks in the billions from Bank of America during the 2008 meltdown, the deal was on preferred stocks, not common stocks, in order to guarantee this payout, these dividends per year. But of course, the investment was in the billions. This is more for the common investor, and it's called common stocks, which does not invest such high levels of capital. Now, what is the difference? If dividends are already something that is not guaranteed to be paid out, and if they are paid out, they are paid first to preferred stocks, so common stocks only get dividends if there is any money left after paying the preferred stocks. Another characteristic of preferred stocks dividend is that these tend to be fixed. The dividend tends to be fixed at a certain percentage of the nominal face value of the stock. Now, common stocks, these dividends tend to be variable, and dividends tend to be higher as firm grows. So these tend to be highly correlated to the growth rate of the firm. If so, then we need to take that into account in the formula that we use to evaluate the fair price of the stock today. And in this context, all that we need to do is to adjust the formula to take into account the growth rate of the firm. So the higher the growth rate, the higher is going to be the price of the stock today because of this negative sign. Because as the growth rate goes up, the entire denominator goes down. And if the denominator goes down, then the present value goes up. So let's assume that the dividend tends to be $100, starting value kind of thing. The required interest is 6% per year, and that the growth rate is expected to be 3% per year. What is the valuation of the common stock? Well, we plug it here. And in this case, we'll get $3,333 as the fair price of the stock. Now, it's worth mentioning that this is not capturing the full expected return of your investment. One thing is valuation. Another thing is how much did you actually got with your stock investment. So let's look at that now. Return on a stock investment. And let's say we just bought one share times 0. Let's say we paid $100 payout of $100. Then we were getting, let's say, $8 in dividends per year during 3 years. And at the end of this third year, we decide to sell the stock. And let's say we sold it for $160. So we bought it, paid $100 per stock. Then a year later, we collected a dividend of $8. And at that year 3, upon receiving the last dividend, we sold the stock for $160. What was the return on this stock investment? So regardless what we call it, what we have here is a timeline. Right? And we already have the tools to compute this. So the proxy for rate of return, as we learned earlier on, is the internal rate of return. Rate of return is just another name for internal rate of return. And the internal rate of return is the rate that makes the net present value equal to 0. So we would compute what is the interest rate that makes the net present value of all these cash flows equal to 0. So we put here minus 100 cash flow at time 0, then $8 at time 1, leaving the interest rate as an unknown, then another $8 at time 2, with the interest rate as an unknown, plus the $8 we receive at time 3 in addition to the 160 discounted 3 years. So what is the interest rate that makes this equation true? Meaning the net present value equal to 0. Using the solver, you get an internal rate of return of 23.90% per year. So that's the return on this specific stock investment, which is different from stock valuation. So now let's talk about corporate finance, topic that starts on page 157 of your textbook. Imagine an entrepreneur. You want to start your business, you have this idea, you know the location, you know what you need, but you need money. Money to buy the equipment, to buy a store, for example, inventory, whatever is needed. These are the typical alternatives that companies use to collect funds. They divide themselves into two broad categories: equity and debt instruments. Equity instruments typically comprise preferred stocks or common stocks. That means giving up part of the ownership of the company, or using your own money, also known as retained earnings, if the company accumulates retained earnings throughout its life in order to make additional investments. So it could be own funds or selling part of the company. These are equity, as opposed to debt instruments. So this is borrowing. And when we borrow money, either as an individual or as a firm, we need to pay it back plus interest. So loans is when we use these financial intermediaries to get, for example, a bank loan. And bonds are issued by the company itself. It still uses financial intermediaries to find buyers for those bonds, so it pays fees to those intermediaries, but these are issued by the corporation itself, whereas these are basically the typical loans. What is the difference between the two? Well, the fundamental difference is, for example, that when the company goes south, let's imagine that the investment went south, it was not a good investment. We still have to honor our debt obligations. We don't need to pay dividends, but when the company goes south, these are among the first that need to be honored. When a company is growing, then the equity owners are the ones that benefit the most, because as the company grows, for example, common stockholders can get higher dividends. There's going to be more retained earnings. So finding the right balance between equity instruments and debt instruments is quite an art. Some corporations are more equity based. This tends to be, for example, startups. And older firms tend to go more to debt instruments because they don't want to give up ownership in the company. But at the end, it's a choice, constrained by many other things. For example, nobody wants to buy your bonds. Nobody wants to give you a loan. So you are forced to give up part of the firm if you are to get financing. So there are other constraints. but there is a list of options. Now, every source of capital, being it in the equity category or in the debt category, is going to come with a cost. And we're going to proxy that cost with an interest rate. The cost of capital, either raised by equity or debt, the proxy for it is an interest rate. And what we are looking for is for the weighted average cost of capital. We are looking for the weighted average cost of capital. How much is that? Well, as the name implies, it's going to be a weighted average of how much does it cost each source of capital that we used, let's say we use them all, multiplied by the weights that the money raised through each one of these instruments, the weights that they represent out of the total amount raised. So imagine there is 5 potential sources of capital, and let's say we raised 20 million from each, so there will be 100 million in total, and each one would be representing 20%. So that will be our weight per category times the interest rate associated with each one of these sources. We're going to look at that in more detail, but the key concept to retain is corporate finance. The ultimate goal here is to calculate, within the realm of our textbook, is to calculate the weighted average cost of capital, which is basically an average cost for the capital raised given the sources that we got it from and how much we got from each source. Before we proceed, and to make sure you read the textbook, let's look at how are the typical operations of the firm in order to assess who's paid first. So the company has its operation, and at the end of the fiscal year, for example, the money generated by the firm, how is it allocated? So as highlighted on page 158, first we pay all production and operating costs. Then, if there is money left, we pay principal and interest payments on debt. Right? So that means paying what we owe to the bond and loan holders, right? Namely the interest payments in this case. Third, if there is income after these expenses, we pay taxes, and only then we start paying stockholders if there is any money left. So first, the preferred stockholders are paid their dividends, and then if there's money left, we pay the common stockholders. And after paying all these agents, if there's still money left, then they can be allocated to retained earnings, okay, kept in the company treasury to fund future investments and operations. So again, first paying all the production and operating costs, so that will include labor, for example. Second, honoring the debt, then taxes, and just then stockholders. Firstly to the preferred stockholders, then the common stockholders, and if there's no money left, the retained earnings. So when making investments, if you rather prefer to buy bonds or stocks, this is something to take into consideration, knowing where are you ranked in terms of priority of being paid. To illustrate how to compute the different costs of capital and at the end the weighted average cost of capital, we're going to use exercise number 2 on page 171. And basically it says that the company has the following capital structure. It gathered funds using loans, bonds, common stock, preferred stock, and retained earnings. Namely, 4.6 million in loans, and associated with it was a 15% before tax interest rate with semi-annual compounding. So this brings us back to chapter 2 and finding the effective interest rate. In bonds, they raised 5.7 million, and they giving us already the effective annual after-tax interest rate of 7.34%. We're going to look at this case in detail. Then common stock, they raised 5 million, offering a $6 dividend on a selling price of $55 per share. Using preferred stocks, they raised 2.8 million, offering $5 dividends on a selling price of $48 per share. And lastly, they rose 3.3 million in retained earnings. The question says, if the income tax rate is 40%, what is the overall tax average cost of capital? That is the weighted average cost of capital. If the company has been growing at 6.5% per year, ignore broker's fee. So what we're going to do is we're going to solve this exercise assuming that there are 0 broker's fees, and then solve again the same exercise with broker's fees. So we see the different methodologies in computing the weighted average cost of capital. In particular, the cost of capital coming from each source and then computing said weighted average. So we are doing exercise 9b2 on page 171. The overall info that they provide is that tax rate is 40% and the firm is expected to grow at 6.5% per year. Okay? Let's take care of the first case, the loan. And the loan, they say, is 4.6 million. And it comes with an interest rate before tax interest rate of 15% per year, compounded semi-annually. So compounded every semester. So the first thing we have to do is to find the effective interest rate per year. Effective interest rate. This is the chapter 2 stuff. The effective interest rate is that the interest rate is equal to 1 plus r prime divided by j to the power of j minus 1. The j is the frequency of compounding, and the r prime was the nominal interest rate per payment period. Since nothing is said explicitly in the question, we're going to assume that the nominal interest rate per payment period is the 15%. We're going to assume a single payment per year, though it's compounded semi-annually. So what does that mean? It means that we're going to have 1 plus the 0.15, which is compounded every semester, so it's going to be 7.5 per semester, and twice a year. And this brings the effective interest rate to 0.1556.25, which is approximately the same as saying 15.5625% per year. It's the same as saying. But Uncle Sam, the IRS, allows us to deduct interest payments from tax obligations. And since the tax rate is 40%, in order to compute the actual cost of this loan in percentage, we need to take out the tax break. So we're going to use KL. Just K is typically the variable we use in economics to denote capital. And KL basically means capital acquired through loans. So KL, the cost of capital when that capital is raised using loan as the financing instrument, is basically equal to the effective interest rate we computed over there times 1 minus the tax rate. So we're going to have the 1556.25% times 1 minus the tax rate of 40%, and this brings us to 9.3375%, which is approximately 9.34%. This will be the cost, KL, of raising those 4.6 million, given that we've been charged 15% per year compounded semi-annually, which would translate in an effective interest rate of 15.5625% per year. However, since we are allowed to have a tax break on those interest payments, the adjustment is given as such: the interest rate, the effective interest rate, times 1 minus the tax rate. So we end up with a cost of 9.34% per year, the cost of raising those 4.6 million through loan. Now, even if there were broker's fees, it wouldn't impact this variable, the loan. The broker fees, when they are referring to broker's fees in the textbook, they are referring to fees charged in the selling and buying of stocks and bonds, not loans. So regardless if there are broker fees or not, the cost of raising capital using a loan is 9.34%. So, based on this information and towards our ultimate goal, that is to compute the weighted average cost of capital, created this table to start filling out the information we find. So for the loan, we just found that the KL, cost of capital of raising money from loans, is 19.34%, with or without a broker's fee. Now you could say, usually banks also charge an origination fee. True, it's not addressed in this exercise. The only type of fees that is contemplated in our textbook is the one with the exchanges for bonds and stocks. So therefore, our KL is 9.34%, regardless if we have broker's fee or without broker's fee, because in our scenario it does not impact loans. The amount, let's just put it here already, was 4.6 million, and the weight is going to be what is 4.6 million represents out of the total amount of money raised. So what is that percentage? We'll compute it towards the end. Now we're going to address the bonds, and the bonds, they said it was $5.7 million raised in bonds, and they told us that the effective interest rate after tax was 7.34%. So in this exercise, the KB was given straight to us. No need for computations. However, I want to impose a 5% broker's fee just to show you how would you solve in that scenario. To do that, we're going to have to simulate a scenario where the 7.34% it's true, and then work from there to take into account the 5% broker's fee that we are simulating. So how would we do that? In fact, I have already solved, because this video recording was interrupted due to my disk being full, so I'm going to use it. So now we're talking about the bond scenario, and the information that is given in this exercise is that, okay, we raised 5.7 million, and that the effective annual after-tax interest rate is 7.34%. So without the extension that I'm doing of contemplating broker's fee, we will just proceed since we already have the KB. However, let's simulate a more complex scenario. So that, like I mentioned a couple of minutes ago, to do that we have to extrapolate where this came from. So to do that, let's assume that we issued bonds with 5-year maturity, a coupon rate of 10% paid annually, a face value of $1,000, and then we need to compute the coupon payment. Now, from previous chapters, you know that the coupon payment, it's equal to the coupon rate times the face value. So in that case would be just another bucks, 10% of $1,000 face value. However, when we're paying interest, Uncle Sam, the IRS, allows us to deduct these interest payments from our taxable income. So the net coupon payment is what we are really looking for. So and the net coupon payment is equal to the original coupon payment times 1 minus the tax rate. Since the tax rate is 40%, then we're going to end up paying not $100 per year, but $60 per year. Our timeline then would look something like this. A 5-year maturity bond with annual payments of $60. And in the year 5, we pay the $60 plus the face value, as we usually do with bonds. And for these to hold true, right, this is the typical formula for a bond, the present value of a bond, with the annuity component, the $60, plus the repayment of the principal at the end, the face value. So we were told that the interest rate was 7.34%, therefore that's the interest rate used to discount these cash flows. And for that to be true, then the price, the fair price for this bond was $945.55. This is how much the firm would receive, actually raise, per bond issued. However, if there is an intermediary, a broker, that is mediating this operation and charges a fee, then what we're going to receive is this amount minus the broker's fee. So assuming that there is a broker's fee of 5%, the value received is equal to the selling price times 1 minus the broker's fee. So the $945, taking out the 5% paid to the broker, would leave us with $898.27. But if this is the amount that we actually receive after paying the broker, then the cost of raising money with bonds is going to be actually higher than 7.34%. How do we find out that exact amount? Well, we're going to replicate this formula over here for bonds, now imposing as the present value the amount actually received after paying the broker, which is $898.27. We're still paying the $60 to whoever bought the bond from us through 5 years and paying the face value at the end. What is unknown now is the interest rate, the cost of this operation for us. So solving this, like you would do in a scenario to find the internal rate of return, we get that the interest rate that makes this equality true is 8.58% per year. So this is the KB, the cost of raising bonds, raising money through bonds, if there is a broker fees of 5%, whereas the 7.34% is the cost of raising the 5.7 million in bonds if there is no broker's fee. So bringing back that to our table, what we found was that for bonds with no broker is 7.34%, the cost of raising the money, but with a broker that charges 5%, the cost ends up being 8.58. Note that it's not just adding the broker's fee to the 7, otherwise it will be 12.34. No. You need to find what is the interest rate that makes this payout stream equal to the money you actually receive. What is the interest rate that makes this equality true? And that's our KB with the broker, 8.58. Okay, so next in the exercise, we have the case of the common stock. And they say that we were able to get 5 million by issuing common stocks, and that the dividend, expected dividend will be $6 per year per share. That's not explicitly stated in the question, but is assumed, is nothing different is said. And that there was a selling price of $55 per share. Of course, this is the amount received if there is no broker. If there is a broker, we need to take out the 5% fees we are assuming that the broker charges. Let's put actually here 5% fees. So how do you solve this? We learned earlier in the chapter that when we are doing a common stock valuation, then we need to take into account the expected dividend, the market interest rate, and the growth of the firm. What we are interested in finding here is the interest rate. So if you solve this for I, and move stuff around, and then you divide everything by P here, this is what you get for the formula of KCS. The cost of capital by raising money issuing common stock, as shown in page 164. So it's still the same formula we learned earlier in the chapter to evaluate a stock, a common stock. However, it's solved for the interest rate, which is, in the case of the framework for the weighted average cost of capital, what we call KCS, capital coming from common stock. Now, let's start with the initial scenario that there is no broker. That's how the question is originally framed. So if there is no broker, this KCS, which is equal to the I, that original formula, is going to be equal to the $6 per year divided by the price, which is $55, and this is a plus here. This is a plus. When I move the minus PG to the right hand side, I should have switched the sign. So realize it now, because it wouldn't make sense to take out the growth rate. We should add it. So the growth rate for the firm is expected to be at 6.5%, if I recall correctly. Yes, indeed. G at 6.5%, so 0.065. So this would give a KCS of 0.1741, the same as to say 17.41%. That will be the cost of raising capital issuing common stock. Now, what if we have a broker that charges 5% fee? Well, in that case, we need to focus on the net price received. So if there is no broker, we would get the $55. If there is a broker, is 95% of this. So the new KS would be $6 dividend divided by the net price received, which is the price times 1 minus the broker's fee, then plus the 0.065. This would give 0.1798, meaning 17.98%. Also, it's worth putting here a note. This is the net price received, which is equal to the price times 1 minus the broker's fee. So let's put this information in the table. What we found was, okay, common stock, KCS. If we have no broker, 17.41%. If we have a broker, 17.98%. And the amount raised was 5 million. The next item is preferred stock. The books refers merely as KP for preferred stock. And the last one is going to be retained earnings, which the books refers as KRE. So now we're going to look at the preferred stock. And for the preferred stock, this question states that we're going to raise 2.8 million. So preferred stock, let's just write it here. And the idea is pretty much the same as before when we're doing the valuation of a preferred stock, because it's fixed dividends. It does not take into account the growth rate. So if we're looking for the cost of raising money through this, we solve for the interest rate and we get this simple formula, and that's the KP, the interest rate that makes that equality true. We can rename it KP, capital that comes from preferred stock. So with no broker, for this scenario, the preferred stock, the question says that there's going to be $5 dividends per year and the selling price of $48. So we plug that here. The dividend is 5, the selling price is $48 with no broker. This is the interest rate, the KP. So this would give 0.1042, the same is to say 10.42%. Now what if we have a broker? Same rationale as before, 5% fee. So the new KP is going to be the dividend divided by the net price received. So the $48 times 1 minus the broker's fee of 5%. Again, the idea of net price received. And this would raise the cost of raising money with preferred stock to 10.96%. So 10.42 with no broker, 10.96 with a broker. So let's add that to our table. So we got 10.42 if we are to raise money using preferred stock without a broker, and if there is a broker, then it's 10.96. Now lastly, another source used to raise money in this question was the retained earnings, money that the company already had, their own funds. You can think as the entrepreneur owns funds. And what the textbook teaches us is, for this, use the same as you do for common stock. So we will have 17.41 as the cost of raising money through retained earnings. And this is explained on page 164. The retained earnings show up on page 164. Basically, they say assume just the same cost as you would have if you were to issue common stock. And in this case, if you are using your own funds, even if there is a broker mediating operations, the other ones, they don't mediate the use of your own funds. So this would remain unchanged, regardless if there is a broker or not. So note that what the broker has an impact in is the cost of raising money through the issuing of bonds, raising money using common stock, raising money using preferred stock. The broker fees do not impact the cost of raising money using a loan, nor the cost of using money using retained earnings. So now that we have the cost of raising the money through each one of these 5 instruments and the amounts that they represent, let's compute the weighted average cost of capital. To compute the weighted average cost of capital, WACC, then first we need to find the weights. To find the weights, we need to find first what is the total amount of money raised. So we would add all these amounts raised through the different instruments, and we would find out that the amount raised amounts to 21.5 million. So then the weight of the amount raised through loans is basically equal to how much did we raise through loans? 4.6 million. What was the total amount raised through using all the instruments? 21.5 million. So how much do the loans represent as a percentage of the total? And that is 21.86%. Similar reasoning for the other ones. How much does 5.7 million represents out of 21.5 million? So you would get 0.2651, the same is to say the 2651%. And repeating this procedure for the remaining rubrics, you'll have 23.26% for common stock, 13.02% for preferred stock, and 15.35% for retained earnings. The summation of all these amounts has to be 100%. So I always do the addition as a robustness check that there was no mistake. So once we have the weights, then we compute the weighted average, which is basically going to be the summation of cost times weight plus the cost times weight plus cost times weight plus cost times weight plus cost times weight. Weighted average cost of capital. So with no broker, WACC summation of what is the K for that rubric, what is the weight for that rubric, weight. So this would be for loans is 934% times the 0.2886. So I chose to write this as the percentage and this in decimal form, so I get the result immediately. I advise you use that as well. Bonds is 7.34% and the weight is 0.2651. Then the common stock is 17.41 times the 0.2326. This is all percentage. Then for preferred stock, 1042 times 0.1302, and retained earnings 1741, the same as the common stock, but the weight is 0.1535. And this would give a WACC of weighted average cost of capital of 12.07% per year. Okay, the book has 12.08 as the solution, so this is the rounding stuff. Now, what if we have the broker's fee? So the weighted average cost of capital would change with broker charging a 5% fee, and these were the costs we found. Right? So we're going to again multiply the cost times the weight. So that'll be 934 for loans, unchanged because the broker does not impact that, at 0.2186 the weight. Then for bonds it did change, now it's 8.58 and the weight remains at 0.2651. Then we have the common stock, which changed to 17.98 times the weight of 2326. Then the preferred stock also changed to 1096. The weight remains at 1302. And retained earnings remains unchanged at 1741, the weight of 0.1535. And we are done. So we have the 5 sources of capital, meaning that overall our cost of capital, if we use a broker, goes up to 12.60% per year. So this is how you find the weighted average cost of capital. Recall that what we did here was an extension of the textbook exercise to go over all the concepts and bring the role of a broker in the middle of all this. So the original question was with no broker, that's the way the question is written in the textbook. And we went step by step to find what was the KL, the KB, the KCS, the KP, and the KRE, according to the 5 different sources of capital. And then we redid basically the exercise, taking into account that there is a broker charging 5% fee. So we realize that loans and retained earnings remain unchanged if we have a broker, because the broker, as it is stated in the textbook, only mediates the buy and sell of bonds and stocks. So that's the only categories that you will have an impact in. And we simulated for the bond and we got 858, common stock 17.98, and preferred stock 1096. Once we have the cost of raising capital per source, then we need to figure out, okay, how much money did we raise per source? How much the total amounts to? Then, how much that each source represents as a percentage of the total. Those are the so-called weights. You can put their weights. So that's why we need to compute the weighted average cost of capital, the weights times the cost of capital, and add them up. The summation, the cost of capital times the weight from each source. And that's what we did. So that's all for chapter 9.